Hello and welcome to Capital Markets Live. I am John Getches, Senior Vice President of Capital Markets at Jennie Mae. And today I am joined by Ted Tozer, past president of Jennie Mae, during which time he managed nearly $1.7 trillion portfolio of mortgage-backed securities. Currently, Ted is a senior fellow at the Milken Institute, is the president of Ted Tozer Advisors, and a member of the board of directors of Penny Mac. Prior to Jennie Mae, Ted was also a long-tenured career as Senior Vice President of Capital Markets at National City Mortgage Company, served as a charter member of the National Lender Advisory Boards of both Fannie Mae and Freddie Mac, and was served as chairman of the Capital Markets Committee of the Mortgage Bankers Association of America. Welcome, Ted.
Thank you, John. Thank you for the invitation.
I think it's safe to say that you are no stranger to successfully managing through a financial crisis. And with that, our first question is, what do you see as the current challenge facing the mortgage market in the recovering stage after this pandemic?
The biggest challenge the industry is going to have is that as we move out of the pandemic and it subsidizes, is to try to minimize the disruption for borrowers that are currently delinquent. Current portion of the delinquent loans are in forbearance. We really don't know yet really how many of these people are going to be able to afford their payment once they come out of forbearance, because right now they're not obligated to make those payments. Again, FHA has given the servicers some really powerful tools to work with the consumer to minimize that disruption. FHA will allow for loan terms to be modified and will allow forborne payments to be added to the end of the mortgage as a form of a partial claim, which is a huge thing that will really help borrowers come out of their forbearance successfully.
That's a great segue to an interesting topic that many of our listeners are asking about. The loss mitigation waterfall represents the toolbox with which our mortgage-backed security issuer and servicers will process a significant number of households exiting forbearance very soon. Let us explore loan modifications and their impact during this episode. Ted, as a result of the COVID-19 pandemic and the economic turmoil that followed in its wake, the number of serious delinquencies has swelled. Jennie Mae portfolio and underlying insuring agencies have approximately 1 million loans in serious state of delinquency and forbearance. What do you see as the end game for those loans after the forbearance period?
I'm really optimistic that really the vast majority of FHA loans will be brought current through the partial claim process, like I mentioned before, where the forborne payments are just added to the end of the loan and they just go back to their original payment. I mean, borrowers who are rehired into the job that they had prior to the pandemic will be able to make their payments, since they're not going to have to worry about having to catch up on delinquent payments. These borrowers only need to have their forborne payments added to the end of their loan through the partial claim process. Some FHA loans will be a challenge to make the original mortgage. People, when they give a new job, they're not going to have the income they had before. And these loans will either be restructured through FHA modifications or they'll be forced to sell their homes. I think foreclosures will be very limited because the strong housing market in virtually all parts of the country will avoid a situation where people will have to actually go to foreclosure. They'll just sell their homes to pay off their mortgage if they cannot make their new payment.
That certainly is an optimistic view. FHA and VA offer similar type forbearance exit strategies to their borrowers. FHA has the partial claim, which has been their biggest support and allows for different options to the borrower. The new news is that on recent Friday, the end of May, the VA has issued a final rule related to the COVID-19 Veterans Assistance Partial Claim Payment Program. What are your thoughts related to the changes the VA has made to their partial claims program?
The VA partial claim program will allow for veterans to add forborne payments to the end of their loan through a silent second that will not count against their loan guarantee. Since the VA guarantee is limited in size, excluding the silent second from the loan's guarantee will be a major support to the veteran and to the servicers.
I see by the VA's recent announcement, it increased the size of the silent second to a maximum UPB cap of 30%, and has estimated that this change alone in the final rule will allow approximately 9,000 additional loans to participate, assuming the other requirements are met, with minimal additional financial risk to the government. Do you see other changes the VA has made to the partial claim program having a similar impact?
No, the VA has done a great job in minimizing the risks to the veteran with this groundbreaking Silent Second program.
That's certainly good news. Ted, as you know, each agency has its own loss mitigation toolkit. For our audience, can you brief us on the VA longstanding history of not prescribing a required waterfall of home retention options? VA has instead advised the VA's preferred order of consideration for standard home retention options.
The VA modifications in the past have been very valuable because they would let interest rates falling substantially. In the past, by reducing the borrower's interest rate substantially and capitalizing liquid payments, as well as reamortizing a loan over 360 months, the veteran that had their income reduced could possibly afford their modified payments. Over the last couple of years, we have not seen a drop in interest rates large enough to materially change the veteran's payment through loan modification. The VA partial claim, in combination with the loan modification, becomes a very powerful tool. Since delinquent payments will only have to be paid by the veteran when they sell or refinance their home, reamortizing the veteran's loan and reducing their interest rate, even if only a small amount, could be enough to make the payments affordable for a veteran who has seen their home have their income reduced.
For the VA borrower whose income changes significantly post COVID, do you think most servicers will offer the new partial claim payment to veterans, even though it's not mandated by the VA?
I think services will determine if a combination of partial claim and no modification will create a payment the veteran can afford. If an affordable payment can be achieved, they will offer the new payment to the veteran. If the modified payment is not affordable, then the service will probably work with the veteran to sell their home. If the veteran sells their home in a timely manner, their credit will not be damaged.
I see. The VA continues to explore ways to help veterans as they exit their COVID 19 forbearances and as foreclosures and eviction moratoriums end. VA expects the upcoming weeks to provide critical information in evaluating the COVID DAPCP and additional measures to help veterans. Do you have any thoughts related to additional measures to help veterans?
One help that I see is VA providing, in addition to the partial claim and loan modifications, is to give funds to the veteran to help with the cost of transitioning to a new home if the combination of loan modification and partial claim does not allow them to have an affordable payment.
If we were to assume a large number of borrowers in forbearance are in industries greatly affected with income reductions and unpredictability, such as the hospitality industry, any idea about the level of decline in pre-COVID household gross income?
I think there could be a bright spot on the horizon. Currently, the hospitality industry is reporting a shortage of available workers. And this worker shortage could be an indication that borrowers who lost their jobs in the hospitality industry might be able to move back into the industry, not only at their old income levels, but even possibly at higher income levels. This is an example of why we do not know just how big a challenge moving borrowers out of forbearance is going to be. A month ago, no one saw this worker shortage materializing.
I think that's an interesting point that there's a lot that we don't know yet, other than the scale of the delinquent population. What do you see as home disposition strategies, assistance, or strategies that the agencies could be thinking about? Do you have any recommendations on those policies?
Because the housing market has been so strong, the amount of loans that will be foreclosed on or and sold through the REO process should be very low. Since the guaranteeing agencies will not have to shoulder the cost of foreclosure and REO sales, the guaranteeing agency should evaluate providing borrowers funding to assist in transition to new housing. For example, the agency could pay for the moving costs and deposit on the new home if they'll be renting.
Switch the questioning a little bit. Hit you with this surprise. As you know, the Secretary of HUD has stated that there will be no change in the mortgage insurance premium in the near future. What is you see as the reason for leaving the mortgage insurance premium alone for now?
The issue facing the housing market today is not a lack of demand, it's a lack of homes to buy. A cut of the MIP would only create more upward pressure on home prices. The borrower would probably not see a lowering of their monthly mortgage payment reflective of the drop to MIP because they would have to pay more for their house. That their higher loan amount would more than offset the benefit of the lower MIP. The value of the MIP cut would be passed virtually 100% to the home seller.
I see. Interesting point. In addition to the Ginnie Mae Pass-Through Assistance Program, which we call PTAP, a lending facility for servicers of government mortgages, what are your thoughts on other actions that could be taken to provide needed additional liquidity for our issuers and servicers?
There are a few options for funding for non-bank Ginnie Mae issuers. Non-bank issuers rely on lines of credit from banks, and larger issuers have issued term debt in the capital markets. The issuance of term debt enables issuers to have a more predictable source of funding. There has been some talk of non-bank issuers becoming eligible to join the Federal Home Bank system. The value of Federal Home Bank membership is limited since all advances have to be fully collateralized. And the main assets an issuer owns is their MSR with their mortgage servicing rights. Most non-banks have pledged their MSRs as collateral against their lines of credit. I do not know what unencumbered assets non-banks could pledge to the Federal Home Banks. One solution possibly could be to allow non-banks to issue government-guaranteed unsecured debt. These offerings look very similar to bank FDIC insured deposits.
There also has been some talk about a 40-year term for modified loans. Your thoughts about this from each of the stakeholder perspective: issuers, borrowers, the investors.
The investors in Ginnie Mae MBS are a critical factor. How will investors weigh the pros and cons of a 40-year fixed-rate Ginnie Mae MBS? They will need to weigh the fact that the 40-year MBS will not be TB eligible and will have limited liquidity versus the fact that borrowers in a 40-year MBS will have limited refinance options. If investors are willing to pay the same price or higher for a 40-year Ginnie Mae as a 30-year Ginnie Mae, borrowers will be able to have a material improvement in their mortgage payments by amortizing the current loan over 480 payments. If investors require a discount in the price versus a 30-year Ginnie Mae, the value of modifying the loan terms to 480 months will be minimized. The issuer in this situation should be indifferent. They only offer a loss mitigation option to a borrower that does not cause a loss to themselves financially.
Interesting times, interesting economics, interesting tools that are becoming available. Well, it looks like that's all the time we have for today. Ted, thank you for your time and sharing insights on loan modifications.
Thank you, John, for this opportunity to take part in your podcast series.
That was Ted Tozer, former Ginnie Mae president. If you enjoyed this podcast, be sure to subscribe to future episodes of Capital Markets Live on YouTube. If you have any comments or questions about today's episode or other topics, please send us an email at ocmglobalinvestorinquiries@hud.gov. Again, that's ocmglobalinvestorinquiries@hud.gov. Again, thanks for listening, and until next time, stay healthy and safe.